When the Trump administration proposed capping credit card interest rates, the goal sounded simple: make credit cheaper. But credit has a very long history of teaching us that quick fixes often create new problems. Rate caps can lower consumer costs, but they also would shrink access. One counterproposal was that stablecoins could be a market-based alternative to blunt the access problem, a way to lower costs without breaking the system. But new rails bring new risks, and faster money forces hard trade-offs. Whether we like it or not, new rails still call into question who gets credit and at what costs. So the question isn't just whether stablecoins can lower interest rates, it's whether they change the economics of credit, or do they just move the consequences somewhere else? Today, my favorite snarky guest, Ron Shevlin, head of research at Cornerstone, and Rhett Roberts, CEO of LoanPro, and I unpack the unintended consequences of politically expedient fixes without addressing the first principles. Today, on Breaking Banks. Ron, your piece in Forbes, you did a good job outlining part of the proposal. We'll get into some of your beliefs around the why it came into being, but why don't we start with the what around the proposal that has come out of the administration by executive order, which is interesting, that hasn't been done before around this. But where did the idea of the 10% APR cap come from?
Oh, shoot. You're asking me where it came from? I don't know. Probably an advisor to Trump who thought that this would be a good way to kind of grab the stage, grab hold of the issue around affordability. I think this is really what it's all about. I mean, basically what the proposal is a temporary, I think a 1-year cap on credit card interest rates at 10%. And of course, for many people who are revolving their card payments, they're paying anywhere from potentially 24%. So this would reduce their interest payments. What's really, to me, a little confusing about the whole proposal is, first of all, this was supposed to be a 1-year cap. It made no specific references to whether this was how far back you'd go for these things. Is it just going forward for things? So I think that even the industry is kind of a little confused as to exactly what the details of this would be, because so far we have not really seen anything more specific other than some claims, and I think Trump brought it back up when he was in Davos this week. But this really requires congressional approval, and that there's some arguments whether or not that would make it through. But so far, I mean, as we are recording this, Jason, we're past the original deadline that Trump had issued. So a lot of confusion over this and a lot of speculation. But the bottom line, this is a cap on interest rates at 10% for a year.
Yeah. Well, let's unpack, because even though we're past the deadline, this has surfaced before, right? From both sides of the aisle, this idea of a cap. And so let's talk for a second about what's the real problem we're trying to solve in doing this. And right, like LoanPro powers lenders of all shapes and sizes, and therefore can see through both to their consumers and businesses. What do you see as the real problem the cap is trying to solve?
Yeah, I think Ron's correct. This concept of affordability, it's been kind of popular as far as people are interested for clickbait to learn more about it, right? Do I get a lower interest? But the problem is, of course, if this is like a populist sort of hey, we're aligned with you, we're trying to make things that more affordable. Problem is the evaporation of available credit, right? It just doesn't work. The math doesn't pencil. And there's been several reports come out. Jamie Dimon spoke out one actually while he was at Davos. There are a couple of reports of a few reports that have a few ranges, but generally about 80% of existing cards will either be canceled or have a material reduction in the available credit. So if you're doing it as a move of, I'm trying to get votes, which assumption that is what it is, it's only for a year, right? You're just trying to get past an election time. It's probably actually going to backfire, because you're going to move people from being annoyed and frustrated they have a higher interest rate to being mad that they have no credit at all. And so I think it'll be interesting, but I do think it highlights maybe a disconnect between, this is really an unsecured consumer loan that's being
Yep.
issued to a variety of credit-worthy spectrum customers. And most folks wouldn't pull cash out of their pocket and lend it to a friend in an unsecured consumer loan at less than 10% interest.
Yeah. Well, if you do, I don't think you call it a loan. You mentally call it a gift. And with no expectation, it probably gets paid. And I think we're maybe all three in like strong alignment that like this is not solving the underlying issue, which is affordability, is people are using credit to finance this. But if you were to put a cap on, I think we would also all agree it is going to push things into alternatives. And one of those things, and Rhett, let's pick this up with you, is you have this thesis around where do stable coins begin to play into this? Like, does that begin to create an alternative, to the traditional credit card system?
Yeah, it's a great question. So if you think about cards, there's really two different kinds of use cases for cards. There's transactors that are paying their bill off in full every month, and then there's folks that carry a balance. And there's rewards that happen on cards, and generally they're try to be kind of competitive. And so the reward funding mechanism is generally the interchange that happens. Sometimes they'll dial the rewards to be greater than the funding that occurs only from interchange. So it's having transactors be subsidized by folks who carry a balance on the APR side. So all of that gets disrupted. Like that whole thing goes in the blender and changes if the APR happens. But a completely separate thing is, let's imagine it does happen, which I'm not saying that's my point of view, but LoanPro has received lots of phone calls in the last couple of weeks of like, okay, let's imagine it does happen. As a lender, what do I do, right? And there's folks who are trying to say, okay, great, I need to provide the convenience of a card. It's pretty easy to pay for things on a card. I love the convenience of a card. Is there a way to continue to still provide convenience of card, but then connect that with a financial instrument? Might be a closed-end installment loan. It might be a line of credit that looks a lot like a card, or a more bespoke lending product that matches. And so there's a few different strategies. We actually signed a deal with MasterCard for something called Loan on Card that's been in the news of recent. The idea that a lender could issue a closed-end installment loan, and then they could provide access to those proceeds through a 0% interest credit card. So that's a sort of a one of the channels that could be done that marries the convenience of payment, but a different financial instrument that's actually a closed-end installment loan. But to your point of stablecoin, absolutely. Stablecoin has a lot of that. If you think about what happens with a credit card network, right? There's a brand recognition. There's significant value in the brand that you can go anywhere across the globe. You can see a logo that you represent. You've never met this person before, and they're willing to do services, and you can pay, and everybody trusts that. So there's significant value in that trust component. But there's also the transmission of the money. Well, stablecoin has a huge leg up on compared to the way the traditional system works with that. And then there's this concept of that stablecoin has not solved, which means it's not right out of the box solving, of deal with it later. And I think one of the things the card network has done really well is if you were to do a transaction that you bought something on Craigslist or whatever from somebody, and you showed up to pay them, if you paid them in cash, you kind of know if there's a problem, you got to deal with it now, right? Like you better figure that out inside the transaction. But if you paid for something on a card, there's this idea of like, if there's an issue, I'll deal with it later. Stablecoin hasn't quite figured that out yet because the protocols and rules of like how chargebacks and how the roles of who's a merchant, who's a all those things would be figured out. But I do think there is a very viable opportunity here for stablecoin to solve a component of the network. And then it's basically an access point. If you view a swipe on a card is the equivalent as a draw on a line of credit, you're just swapping out your issuing processor component to be connecting with the wallet of a stablecoin. And instead of the stablecoin being tied to a stored value wallet like a debit card that you're pulling money out of the existing wallet, the concept is a different financial instrument would be in that wallet that's the equivalent of a credit card. I don't have money in this, but when I go ahead and spend, it's going to be a draw on a line of credit. And I think there's a very viable opportunity for a parallel rel.
Hey,
Ron.
Jason, before you get to the next question, I do want to just react to what Rhett said, because I think he's really spot on with some of the scenarios. But I do think that there are some shortcomings to that, Rhett. First of all, most of what you're talking about, I think, relates to the creation of new credit demand, and not the billions and billions of dollars that are being revolved on a month-to-month basis. Now, for
Correct.
that's in yours proposed, whether it's a new type of card, whether it's going to stablecoin, going through stablecoin or rail, would require a balance transfer on the part of a lot of consumers to do that. And many consumers are in the situation they are today because of lack of financial education, wellness, and literacy. And so I don't even know that many consumers are in that situation, understand what balance transfer is, how to do it, why they would do it, and so forth. And so I think we're asking a lot of that new type of capability to address the existing demand. I don't doubt for a second that what you're talking about would help address the new demand. But
Correct.
over the course of a year, I mean, if you're Cap One, Citi, Chase, how much are you going to invest in this, knowing that in a year from now, everything kind of goes back to normal?
Yeah, that's absolutely fair. And all of my circumstances were based off of conversations we've had with folks to say, how do I pivot? What do I adjust products to be? Which is all based off of new things. But you're absolutely correct. Existing revolving balances. Well, first of all, there's no clarity on what the interest rate caps mean. We assume it means if I carry a balance that's outstanding now, that as of whatever the start date, which was January 20th, that's now in the past, I have an interest rate change down to a 10%, almost like an SCRA or active duty military change. But no details are out there, so nobody really knows.
Yeah. Hey, Jason, the other thing I just quickly want to jump in on, you asked the question, what's the problem being solved here? And I apologize if this sounds somewhat cynical and sarcastic, but hey, I do write the Fintech Snark Tank.
Snark.
The problem here, it has nothing to do with affordability. The problem is Trump's approval ratings and his political stance. This proposal isn't really about achieving affordability in credit card payments. This is actually, I think, a very astute political move. On one hand, he's co-opting the Democrats' position, who've been yelling for interest rate caps for years. And so now what he's doing is co-opting theirs, getting them to have to buy into it. So then when it all backfires, guess who he can point at? Sanders and what's her name?
Warren.
Massachusetts there, Warren. And second of all, he's got a problem with his base right now. It's a 4-letter acronym. I'm not going to use it because the last time I used it, I'm pretty sure I got censored on LinkedIn for using that 4-letter acronym. But, it represents his base, and they're not real happy with him right now because of a lot of the foreign policies. So he's throwing them a bone with this, which is, aligned with what they're looking for. So I think this is really, the problem is Trump's political standing, nothing to do with affordability or consumers.
Well, and if anything, Ron, I worry it makes it less affordable because Rhett, let's focus on the new issuance piece that, the Rhett scenarios for a second, just play it out over the next couple years. I think you can't avoid the fact that risk-based pricing is going to make its way back in. But what we've done is if we're pushing it to stable coins and wallets and outside of things where, for good reason, regulation and consumer protection has been worked out. You may not agree with all of it, but we've found a level of stasis that works relatively well. If we push it onto stablecoin and outside of the credit card rails and therefore also outside of the credit card regulation attached to this, are we actually going to see the risk-based pricing may actually become worse? Because as you both pointed out, if you're doing unsecured consumer lending to someone you don't know, you're probably not pricing at 10%. Is it going to become more usurious than what we're seeing?
Well, I think that the products become bespoke to the use case. And so there's some caps today in network rules that don't serve certain markets because of the risk-based pricing. And so you could have a lending product of the entire spectrum. There's a price you do all kinds of things at, right? And so you just have to get the right interest rate that's going to be tied to those and the math to it. But I agree with you. And the devil's in the details about how you define, like, if you did a stable coin transaction, is that subject to the Card Act? Well, it depends on how you define networks, and so there's a lot of those things to try to figure out the details of. But if the premise of how you framed that, if that's correct, if doing a stable coin transaction is a going around like the Card Act or the definitions of what a network is for a credit card, then yes, I think you're correct. You'll have both good and bad actors, but we can look at the state level to see what happens. When you go ahead and go to somewhere like Texas that does, they do retail installment sales in Texas. They also have a 10% usury with two big carve outs. If you're a depository, you're not subject to it. And if you sell the thing that's being bought, you can do the retail contract sales, so that you're not subject to it. But any random person who wants to give a loan there, they have a usury at 10%. And so what they end up doing is creating called CSO loans. And this idea that you introduce another third party that they're going to service the loan and they charge a fee for that servicing. That fee doesn't count as interest. You can charge a 9.9 interest rate plus a servicing fee. It's actually a worse deal for the consumer. We'll find stuff like that for sure would happen. People are smart. They'll adjust and they'll pivot around things.
Ron, I think you made a similar argument around this with buy now, pay later being just an equivalent that is using some regulatory arbitrage around credit card and unsecured consumer lending. Are there any lessons there in terms of how he's seen BNPL play out?
I don't know the numbers, Jason, but I think, well, first of all, just for anybody's purpose here, I'm actually kind of a big fan of buy now, pay later as a product and a service. I kind of do see it as sort of the entry-level credit card. Instead of issuing somebody a credit line of $100,000, $500,000, you're basically giving them a line of credit for a particular transaction they want to make. And if they pay that off, then they earn the next one and so forth until the issuer can see enough of a pattern in which to actually issue a unsecured loan in the form of a credit card.
Yeah.
So I think, what happens here with this is if you can, and I think Rhett's kind of making this point, although he didn't mention buy now, pay later, is if you constrain the amount of credit that's being issued through the credit card, then first of all, the financial institutions are going to find workarounds to make up for that. But second of all, the consumers or the cardholders, the borrowers who are being impacted by this are going to turn to other products. So they're going to turn to buy now, pay later, which will increase a lot of the demand for that, and then potentially even cause more problem from their bottom line if they're not making payments on time, and potentially even driving folks towards payday loans, which who wants that other than the payday lenders, of course. So, the ripple effect here, I think is pretty broad and not all positive. But, you're the buy now, pay later issuers, you might be in pretty good shape because of some of this.
Back to that stablecoin piece, one thing I fully agree with what Ron's saying. If you go look at both Visa and MasterCard and open up their earnings, you'll see the fastest growing category for both of them is value-added services. So it may be interpreted to say like stablecoin would be a competitive rail to the network. It's actually our thesis here at LoanPro that the networks help build all of that. They have this platform of how you build it, how you deal with the problem later with the chargeback processes and the rules. You see Visa getting involved in a lot of stablecoin settlements and transactions. It's currently a small number in comparison to the overall numbers, but it's still a big number. We're seeing some volumes that happen. So I think this actually turns into a meaningful way to expand beyond the aperture of what's the normal network. And I fully agree, embedded finance offers that convenience factor. And if you can provide the convenience married to the right financial products, we're starting to see a lot more hybrid type products. And the convenience factor that the networks provide is super useful. And stablecoin could be an element to continue to provide convenience.
So if we all agree the act has a bunch of unintended consequences, and what we're really looking for is not actually limiting the access to credit for the people who need it. For both of you, a question as we wrap this up, where should we put our focus? What we're really trying to do is to create access to credit for people who need it in a responsible fashion. Back to the first principles of the problem to be solved. Where should we focus? I don't expect either one of you to have like the complete answer, but where would you focus on doing this in a way that is actually good for all of the parties, not just for the payday lenders of the world or those playing in the buy now, pay later, but it actually is net beneficial to the borrower. It is actually returning, a risk-based return for the lender. Is it the rail? Is it the network? Is it, how we think about pricing? Where would you focus?
Yeah, I'll start first. I think the continuing to allow the support of unique lending products. I like what Ron mentioned, this idea of when you're someone starting out on credit, buy now, pay later is very good for them because it's almost like a layaway program, right? I bought this thing and I'm going to pay it off. I'm going to build my history. And then you expose it before you just kind of open the bazooka of unsecured, it goes for anything. And so I think we start to see a hybrid of different lending products. If you look at it from a regulatory side of things, it's kind of divided in two categories of the consumer and B2B or corporate, but it's also two categories of closed-end installment and open. And what we find is we're starting to find a lot of loans that folks are trying to offer that are kind of hybrids in between. So if the question is what can the government or regulators do to try to unlock that? I think it's providing a little bit of clarity on the gray areas in between these different products from a regulation side of things. Now, it's a very long conversation to get in, like sourcing of capital and the Genius Act and a few things to support the future of those ideas. But all boiled down from our perspective of bespoke lending products that match well for the reason that people are borrowing money.
Okay, I'll go next. To your question, Jason, what should be done? Where do we start? I think the onus of this comes on nothing that's actually internal to the financial services industry, but to economic policies that drive real income growth and cap in the inflation rate, because this is the underlying problem why consumers are running up debt and having to pay a lot of high interest rates on their revolving debt, is that their income isn't keeping up and the inflation rate's not coming down sufficiently to make their income gains real from a positive perspective.
Yeah, this reminds me, this was years ago now, but had Jennifer Tescher from the Financial Health Network on, and one of the surprising rants that she had for me that I absolutely loved was around her belief that most financial literacy is an absolute waste of time and money. And she said, for a person who just doesn't make enough money, they don't need better education. They just need jobs that pay well enough that they can meet the needs, their basic needs attached to this. Literacy doesn't solve that problem. And Rhett, I like what you said around tailor-made products rather than one size fit all. If we think of debt as that blood instrument, which often, I tend, especially in a consumer point of view, to be relatively anti-debt as being toxic to the point made earlier. People don't really understand how their balance transfer and APR and all of that works, right? So it can be inadvertently really bad for them. I like this idea of more tailor-made. If we're going to spark that, I lied, that wasn't the last question before. So if we're really looking for more around the tailor-made, are we really opening the door to say the future of better lending is around AI that drives personalization and embedded because you're matching really the lending product, the financial product with the underlying thing. Because we often forget debt is not an end, it's a means to something.
Right. Boy, that's a big question on the AI piece, right? So the AI piece will, I think, sort of expand and what folks are trying to do. So there's obviously lots of conversations about agentic agents being permissioned to go do shopping on your behalf. And does that make the world better, or I don't know, right? There's some convenience factor that will happen there. Certainly there's AI to do product matching better, and research and risk underwriting and larger data sets to price it appropriately. So it's certainly not a one-size-fits-all. There's a whole bunch of layers to expand, depending what seat you sit in, of using the tools at your disposal. And in theory, this should expand the aperture of the market that is served, because people can have better data to make decisions. And it's not just an underwriter. It's like the loan servicer. It's what markets you want to serve. It's the capital markets. It's all of them would have better data in order to make that decision to expand. But when you come up with wonky rules, like arbitrarily set it at 10%, you're shielding off a very large percentage of the customers that could be served under how the underwriting models would work.
Ron, last rant.
Not a rant. I think just to pick up where Rhett left off on the AI piece, I think it's a two-edged sword, although both positive, first of all, from the industry perspective to make better lending decisions with better information that's driving those decisions. But I think from the consumer perspective, there's the opportunity to kind of have an AI-driven tool looking over your shoulder and saying, hey, Rhett, taking out more credit card debt may not be the best way to go about this. And here are some alternatives, and here's what you do. To your point, Jason, about education, it's funny. Jen and I don't agree on a whole lot of things, but the whole thing about literacy is spot on. Could not agree more. It's like you can't educate somebody this. You need the tools that actually sit over their shoulder, either do it for them or advise them while they're doing it. And I think that's one of the big promises of AI from the consumer perspective.
Right.
Well, I definitely think there needs to be the AI agent saying, if you need to BNPL that burrito, maybe you shouldn't have the burrito, right? Like, you're going to be paying for it later regardless, depending on where you're getting it. Maybe you don't also need to incur debt to do it.
Skip lunch today.
Yeah, easier said than done on that one, but...
Well, thank you both for joining, and maybe we need to relabel this Breaking Snark, because really appreciate the energy you both brought to the subject. Thank you.
Cool. Thank you.
Thanks, guys.
That's it for another week of the world's #1 fintech podcast and radio show, Breaking Banks. This episode was produced by our US-based production team, including producer Elizabeth Severance, audio engineer Kevin Hersham. If you like this episode, don't forget to tweet it out or post it on your favorite social media, or leave us a 5-star review on iTunes, Google Podcasts, Facebook, or wherever it is that you listen to our show. Those actions help other people find our podcast, and in return, that helps us build an audience that can be supported by sponsorship, so we can continue to provide you with our award-winning content every week. Thanks again for joining us. We'll see you on Breaking Banks next week.